Mm, I may say it is a strategy. I don't have a comfortable strategy.
Okay, what strategy were you trading with?
Okay, even now I'm still trading a support and resistance only.
Okay, and you're not profitable. Do you think
Yes,
it's a strategy that is a challenge or your risk and money management?
that is why I still need more learning because I'm still new to the system. So I don't really know if it is my strategy or
Sometimes it's not a
if it is.
strategy. It could be your
Oh,
risk and money management, or
okay.
those are the areas most
Oh,
traders have challenges. Strategy is not a
oh,
difficult
oh,
thing to
okay.
develop, but the area most traders struggle is is risk and money management and trading psychology. That is where most traders have issues.
Okay.
So basically, there are three major things you need to know before you execute a trade. Though this class is for newbies, but since you are the only one
Okay.
in the class, we'll just look at some of the important things that you need to know before you execute a trade. Can you tell me the important things?
Okay.
Can you tell me the important things you need to know before executing a trade?
Okay, the important things to look out for before executing a trade.
Executing the trade, yeah.
I will look out for the trend
Yeah.
of the market.
Okay.
Mm.
After defining the trend, what next?
Then I look for uh I go for to check different time frames, what the market is doing.
Okay. All that is to know the trend.
Okay, it's still under the trend.
Yeah, that's still another trend. After you define the trend, the next thing you need to know is the risk.
Okay, the risks.
That's the next thing.
Okay.
After defining the risk, you should also know the reward, what you stand
Okay.
to gain or profit from that trade. Now, there are several
Okay.
ways, two major ways to define the trend of the market. Can you tell me?
Two major ways to
Define the trend of the market.
the trend of the market. No, I don't know.
There are two major ways to define the trend of the market. Mr. Solomon, you are welcome. Can you hear me?
Yes, I can hear you. Thank you, sir.
Yeah, you're welcome. Mr. Solomon,
Okay.
you are an experienced trader, right?
Sir?
You are an experienced trader.
No, I don't have experience, but
You've never traded Forex.
no. Now crypto I was trading.
Okay, crypto and Forex is the
Yes.
same thing. Okay,
Okay, sir.
it's the
Okay,
same
sir.
thing. Do you do technical analysis or you just buy and hold cryptos?
No. I a little of technical analysis on charts.
Okay,
With the
okay,
aid
so
of
good.
indicator.
Okay, so if you can analyze on the crypto chart, you should be able to do the same thing on in the Forex market. Okay, the
Yes,
difference between
okay.
crypto and Forex is that you trade currencies in the Forex market and you trade crypto in the crypto market. Digital currency is what you trade in the crypto market. In the Forex market, you trade currencies. Okay, so please mute your mic if there is noise at your end. Mr. Okpako, you're welcome. Hold on. Okay, so I have to mute everyone because there's so much noise in the background. So the crypto market and the Forex market are similar, okay? It's just that in the Forex market, you trade currencies. In the crypto market, you trade digital currencies, okay? Now, in the Forex market, you could also trade crypto. You could also trade crypto in the Forex market on the Forex platform. But majorly, the Forex market was designed for currency trading. Okay, so Mr. Paco, are you an experienced trader or you are a new trader? Is this your first time attending the Forex class? Mr. Paco, can you hear me? Please unmute your mic. Let me grant you permission. I want to be sure I'm carrying everyone along. Mr. Paco, you can unmute your mic. Mr. Paco, if you can hear me, unmute your mic or you drop a comment. I want to be sure you're an experienced trader or new trader, please. Okay, let me go on. So there are basically three major things you need to know before you execute a trade. Three major things you need to know before you execute the trade. The first is the trend of the market. The second is the risk. Then the third thing is the reward. The first is the trend. The second thing you need to know is the risk. And the third thing you need to know is the reward. Now, how do you know the trend of the market? There are two major ways to define the trend of the market: technical and fundamental. Those are the two major ways to define the trend of the market. Now, what is technical analysis? Technical analysis involves the use of technical tools, price action, or price history to determine what price will do in the future. Let me repeat that. Technical analysis involves the use of technical tools, generally known as indicators, or price action or price history to determine what price will do in the future. And technical analysis is done on the trading platform, generally known as MetaTrader 4 or MetaTrader 5. That is where technical analysis is being done. So what you're seeing on the screen is called MetaTrader 4. This is where your technical analysis is being done. Just by looking at these images, what we call candles, you can tell what price will do in the future. That is what technical analysis is all about. I also have an indicator here. You can see this line. This is moving average 200. We have hundreds of indicators that can be used for technical analysis. If you go here, you can see these are different indicators that you can apply in technical analysis. So you can see this indicator I have here. This is moving average 200. With this indicator, I can tell when the market is bullish or bearish. Price move in three directions. There are three types of trend. Trend means direction. Price moves in three directions: upward, sideways, downward. And the word we use for an upward trend is bullish. The word we use for a bearish trend when price is going down is bearish. And the word we use when price is in a range is ranging market or sideways market. Those are the three directions that price moves. It's either going up, down, or sideways. So for you to be a consistently profitable trader, you must be able to define the trend of the market. When you launch your MT4 or MT5, the first thing you want to know is the trend. Is price going up or going down? That is the first thing you need to know. For example, this moving average, whenever these candles are printing above the moving average, it tells me that the trend is bullish. It tells me that there's a high probability that price will go up. And when the candles are printing below the moving average 200, it tells me that we have more sellers in the market. It tells me that price is going to drop. As you can see the market was trading below the 200 moving average. What happened? Price fell. Then it went up, closed above this level. What happened? Price went up. You can see how it's played out here. A candlestick closed below the 200 moving average. What happened? Price dropped. So this is what you need to know. And like I said, there are several technical indicators that you can use in trading. If you go online and search for Forex technical indicators, you would see a lot of videos and articles on trading indicators. Now, before you apply an indicator on the chart, first you need to study the indicator. You need to read about the indicator. You need to know how the indicator works. Okay, so whichever indicator you want to apply, go online, search for either videos or ebooks on how to use that indicator. I hope you are following. Very important. You could also apply an indicator or understand how an indicator works by applying it on the chart and backtesting. What do I mean by backtesting? Backtesting means going back on the chart to see how that indicator has reacted to price changes in the past. That is what backtesting is all about. What I just did now using the 200 moving average is what? Backtesting. Even if I don't read any material on this indicator, just by applying the indicator on my chart and going back, I could deduce a theory or a concept on how the indicator works. As you can see, if I've not read anything about this 200 moving average, just by applying the indicator, you will see that each time the candle closes above the 200 moving average, you would see that price went up. And each time the candle closes below the moving average, as you can see, price went down. So you could just apply the indicator. For example, let me apply another indicator here, stochastic indicator. These indicators were developed by traders. Some were developed by mathematicians, okay? So the person who developed this indicator, now this indicator helps you identify overbought and oversold level, overbought and oversold level. Now you can see these lines. This indicator is called stochastic. Now you're to work with two levels here. We have two levels here you work with. We have level 80 and level 20. Level 80 and level 20. Whenever the market is trading above level 80, which means when this line you're seeing is above level 80, it tells you that the market is overbought, or let me use the word, the market is overpriced. Now, when a product is overpriced, what do you think will happen? There's a high probability that price will drop, right? When the product is overpriced. And when this line falls below level 20, the market or the product or that asset is said to be oversold. Oversold, which means the price of that product is low, is cheap. And when the price of a product is cheap, what happens? People want to buy. Remember the law of demand and supply. When demand is high, what happens? Price will go up. And when demand drops and supply increases, what happens? Price will drop. So when this indicator goes below this level, it indicates that the price is cheap. So when it is cheap, people want to buy. I hope you are following. Traders will want to buy. So that is how you trade with these indicators. So there are several indicators you can use in defining the trend of the market. Another approach that you can use in defining the trend of the market is fundamental analysis. Fundamental analysis. Fundamental analysis involves the use of economic indicators, economic events to determine the trend of the market. Fundamental analysis involves the use of economic indicators or events to determine what price would do in the future. Example of an economic indicator that can be used to determine the trend of the market is unemployment rate. If unemployment rate in a country is high, it will have a negative impact on the currency of that country. Also, GDP, gross domestic product, is another major indicator that can be used in defining what price will do in the future, in determining the trend of the market. If GDP of a country is low, it will have a negative impact on the economy, which will reflect in the value of the currency. What you're seeing on the screen is a calendar, a news calendar site where you can access data that can be used for fundamental analysis. So today is Thursday, June 29. You can see it, June 29, Thursday. What you see on the screen are the news that was released from different countries. So you have the date and the time the news is to be released. So if you're a fundamental trader, you make use of economic events. You look at what is happening in the economy. For example, after the election in Nigeria, you would notice that the dollar has been gaining value against Naira. Politics is also one of the major indicators that can be used in determining the trend of the market. So if the Naira is losing value against the dollar, that tells you that the Nigerian economy is not booming compared to the United States. That is why the dollar has been gaining value against the Naira since 1960. Since 1960, since we gained independence, the dollar has always been gaining value against the Naira. That's what fundamental analysis is all about. Okay, so you have news from Euro, from the United States, and yeah, those are the major news that were released today. Euro, USD, yeah, those are the major news. So German prelim CPI was released today. Now, if you look at the calendar, we have two major important data or values that we work with. You can see the actual and you can see the forecast. The actual and the forecast. This actual was released today. This forecast has been given, this forecast value has been given several days ago or several weeks ago. This forecast value has been available and it is released by economists based on the data at their disposal. So they forecasted that the value that will be released today is 0.2%. And the previous value for this CPI means Consumer Price Index, okay? The previous value was 0.1. And they forecasted that the current value, the value that will be released today will be 0.2. So they expected the value to increase. That was the expectation. And what happened? The data that was released, the value that was released exceeded the forecast value. Can you see it? The forecast was 0.2 and the actual was 0.3. Immediately this figure was released, euro will gain value against other currencies. Euro will gain value. So for example, if you were to trade euro USD, euro USD is a currency pair. If you were to trade euro USD, euro, which is the base currency, would gain value against US dollar. So the order you would execute on euro USD would be buy. But if the actual value that was released was less than the forecast, it means that euro will lose value against the dollar. That's if you want to trade euro US dollar. So what type of order would you execute? You would execute a sell order because euro is the base currency and US dollar is the counter currency. When you place a buy order on a currency pair, you expect the base currency to gain value against the counter. And when you execute a sell order on a currency pair, you expect the base currency to lose value against the counter. I hope you all can hear me. You're following. Okay, I'll take your questions before the end of the class. Just note down your questions as we progress. Okay, so USD by 7:30 a.m. Fed Chair Powell speaks. Okay, I think that's the governor of CBN, right? Yeah, the Federal Reserve. The source is from Federal Reserve and Fed. I think it's the governor of. Okay, you can see the head of central bank. Yeah. Okay, so he gave a speech today, this morning. Okay, so you can also use that to determine the value of the United States dollar. Then by 1:30 p.m., final GDP, this is gross domestic product. You can see the value that was released exceeded the forecast value. And unemployment claims, you can see, look at the value that was released, the actual value compared to the forecast value. You will see that the actual value is higher than the forecast value. Can you see that? The released value was 239. The forecast value was 264. Remember, it is unemployment, not employment claim. This is unemployment claim. So when the actual, it is expected that the actual value, you can see, is 239 and the forecast is 264. So the 264, which is the forecast, is higher than 239. So when the actual value, in the case of unemployment claims, is less than the forecast value, it is good for that currency. I hope that is clear. If you have any question, just note it down. I will attend to your question later. So we've looked at what fundamental analysis entails and what technical analysis entails. So like I said, 3 major things you need to know before you execute a trade is the trend. If you don't know the trend of the market, you shouldn't be trading or you shouldn't execute that trade. 90% of traders don't know how to analyze the market. That is why they keep losing money. That's why they keep failing. Most people trade Forex are gamblers. They are gamblers. And if you gamble in this market, you will not be profitable. I can guarantee you that. If you gamble in this market, you will not be profitable. You need to learn how to analyze the market like a professional. Okay? So after defining the trend of the market, you need to know the risk on the trade. You need to know the risk on the trade. So after you've defined the trend, the next question you should ask yourself is, what is the risk on this trade? If this trade goes against me, how much am I going to lose? You have to define that before you execute the trade. If you don't know the risk on the trade, please do not execute the trade because you will lose money. So it's not about knowing the trend. Most traders know how to analyze the market, but most don't know how to define the risk on the trade. That's why they keep blowing accounts. That's why they keep blowing accounts. If you're in this class and you've blown accounts before, it is because you don't know how to manage risk. You have a good strategy, but you don't know how to manage risk. Okay, so I believe by the end of this session, you should be able to analyze the market. You should be able to analyze the risk involved in a trade before entering or executing the trade. Now, there are two types of risk that you need to know before executing the trade. We have the market risk and we have the capital risk. Those are the two type of risk you need to define before you execute a trade. Now, what is the market risk? The market risk is in pips, and it is calculated or defined by subtracting your entry price, which is your buying price. Your buying price is your entry price. Buying price minus selling price. That's how to get the value of the risk, the market risk on the trade. The buying price from your selling price. So let me go to the charts. So let's say, based on the candlestick patterns we have here, I decided to sell GBP Australian dollar. After the formation of this candle, let's assume I decided to execute a sell trade on GBP Australian dollar. So my entry would have been after the close of this candle. And my stop loss, this is where I will set my stop loss. This is where I will set my exit price. Like I said, if I execute a sell trade on a currency pair, I expect price to drop, right? I expect price to drop if I sell a currency pair. Now, there is also a tendency for price to go in the opposite direction. By that, I mean, price can decide to go up instead of going down, okay? So if price decides to go up, which is against my prediction, I'm expected to exit my sell trade since the market is not going in my direction. If I don't set stop loss, it means I'm exposing all my capital. I'm using all my capital as risk, but I don't want to risk all my capital on one trade. That is why I want to set my stop loss so that when the market goes against me in the opposite direction, I would only lose a fraction of my capital. I would only lose a percentage from my capital. That is why I'm going to set a stop loss. Now, for every trade you execute in the market, there is a 50% probability that the trade will go in your direction, and there's a 50% probability that the trade will go against you. You should know that when you execute a trade, no matter how good or how perfect your setup is, your strategy is, that trade can still go against you. Because we have two types of traders. We have two types of ways to define the trend of the market. We have fundamental traders and we have technical traders. So if you're a technical trader and you have a perfect setup on the chart, it is possible that immediately or at the time you are about to execute that setup, a major news will be released. And if the major news is against your prediction, what will happen? Price will go in the opposite direction. So we are looking at GBP Australian dollar, for example, and we have a perfect setup to sell GBP Australian dollar, which is, we expect the GBP to lose value, right? If a major news was released for Great Britain pounds and the news favored Great Britain pounds, GBP Aussie would buy, GBP will gain value. Are you following? GBP will gain value. That is why you cannot win all your trades. You will lose some, you will win some, because there are a lot of factors that determines or the direction price would go. There are a lot of factors, fundamentals and technicals. So don't expect to win all your trades, okay? You will lose some. That is why it is important that you apply stop loss on all your trade. So like I said, if we are decided to sell GBP Aussie, this will be our entry price and this will be our exit price. Our exit price is the stop loss. This will be our buying and this will be our selling price. This will be our buying price and this will be our selling price. So to know the risk on this trade, we will subtract the buying price from the selling price. So our buying price here is 1.9169. 1.9169. 1.9169. And our selling price, this is our selling price, will be 1.9239. 1.9239. Your stop loss is your selling price, 1.9239. Now, if you look at the charts, the quote, the exchange rate is in 5 digits. The exchange rate is in 5 digits. But when calculating pips, we work only with the 4th digit. The pip count starts from the 4th digit after the decimal. Okay, so we don't work with the 5th digit. The 5th digit is called pipette. The 5th digit is called pipette, and 10 pipettes makes up a pip. What we're interested in as traders is the value of a pip and not the value of a pipette. That's why I don't work with the 5th digit after the decimal when calculating pips. Okay, so let's subtract 1.9169 from 1.9239. What we're going to get is 70. Am I correct? Yeah, 70. So the risk or the market risk on this trade is 70 pips. So we have defined the market risk. The next is capital risk. Before you fund your trading account with a broker, I believe you all know, for you to trade Forex, you need to open a trading account with a Forex broker. Without a Forex broker, you cannot trade Forex. The Forex broker is an intermediary between the retail traders and the financial institution. Okay, so for you to trade Forex, you need to open an account with a Forex broker. And the broker I recommend is Cabana Capitals. I believe most of you've registered with Cabana Capitals. If you have not registered after this class, you should register with Cabana Capitals. I expect that everyone who is in this class should start trading after we're done with this class. I expect you all to start trading. I keep saying it. The best way to know how to trade is to trade. It's all about attending classes. You can attend class from now to the end of the year and still not know how to trade. Someone who does not attend class but goes ahead to download the trading platform and start trading on the platform will be better off than you who have been attending classes. I didn't attend classes to become a good trader or to understand the market. I didn't attend any class. All I did was download the trading platform and I was studying the charts. That is how I know how to trade. That is why if I stand with someone who attends a class, I would outperform that person. Okay? So it's all about attending classes. I see a lot of people attending classes. You attend this class, you don't implement what you are taught in that class, you attend the next class. It's not good for you. You'll be confused. You'll be confused at the end of the day. Okay? So as you attend a class, implement. So I expect everyone who is in this class to start trading. When you start trading, that is when I'll be able to attend to you. I make friends with traders. Okay, so you should start trading. Open an account with Cabana Capitals. You can open a demo account or a live account. You don't have to start with live accounts as a beginner. If you are not experienced, you can start with a demo account. Demo account is also referred to as virtual account or practice account. When you open the account, your account will be funded with dummy funds or virtual funds. So you can trade with those funds, okay? Now, for you to operate a live account, you need to make deposits into your account, okay? And on a demo account, the difference between demo and live account is that when you make profits on a demo account, you cannot make withdrawals. And when you make losses on a demo account, you won't be held liable for the losses, okay? But on a live account, you would have to fund with your money. And when you make losses on a live account, you are held liable for those losses. If you make profits, you can make withdrawals and do whatever you want to do with your funds. Okay? Now, the demo chart and the live chart is the same thing. The same exchange rates you see on the demo chart is what you see on the live chart. The only difference between demo and live is that you cannot make withdrawals on demo accounts, but on a live account, you can make withdrawals. So before you fund your trading accounts, you need to know the risk you're going to take on every trade you execute in the market. So let's say you want to start with $1,000. You have to define the percentage that you're going to lose on every trade you execute in the market. And you're advised not to lose. If you're a beginner, you shouldn't risk more than 2% of your capital on any trade. So let's say you started with $1,000. 2% of $1,000 is what? $20. So what this means is that for every trade you execute, you would ensure that you don't lose more than $20. This is why I love Forex. You can manage your risk. You don't lose more than what you can afford to lose in the market. It is only when you don't know how to manage risk, you will lose more than what you can't afford. But if you know how to manage risk, you don't lose. If it is $5 you want to lose on a trade, you can't lose more than that. That is why I love Forex trading. People say Forex trading is risky. Forex trading is risky. But to me, I don't see it as a risky business because I can manage my risk. I can manage my risk, okay? So if I want to lose $5 on a trade, I set my stop loss to ensure that I don't lose more than $5 or $10 on a trade. So tell me what is risky about the business if you can manage the risk. Okay, so you have defined that you don't want to lose more than $20. Now you have 70 pips risk. Now, after you have defined the market risk and the capital risk, the next thing you want to know is the lot size to apply on the trade. That's the next thing you want to know. The lot size. What does lot size mean? Lot size can also be referred to as volume. Volume. And this is a term we use in communicating with our broker, the quantity of currencies we want to purchase. For example, if you want to buy 12 eggs, you don't tell them, I want to buy 12 eggs. You can just say, I need a dozen of eggs, a dozen of egg. So when you want to purchase currency, you need to let your broker know the quantity of currencies you want to purchase. And the term we use is what? Lot size. So on this trade, you want to know the volume of currencies your $20 can purchase. You want to know the volume of currencies your $20 can purchase. So how do you know the quantity or the volume of currencies your $20 can purchase? You do that by dividing your capital risk, which is $20. You divide it by the market risk, which is 70 pips. If you divide 20 by 70, what would you get? Please, if you have a calculator there, 20 by 70, that should be 0. That should be 0. Please, if you have a calculator there, it should be 0.2. Am I correct? 0.2 something. It should be 0.2. Let me get my calculator. 20 divide 70. Okay, that's 0.28. If we approximate it to 2 decimal places, that will be $0.29 per pip. So when you share $20 amongst 70 people, each person will go home with 29 cents. Okay, when you share $20 amongst 70 people, each person will go home with 29 cents. So what lot size would give us 29 cents per pip? What lot size would give us 29 cents per pip? For those who are new, there are 3 types of lot size. We have the micro, we have the standard, micro, mini, and standard lots. Those are the 3 types of lots. So what lot size would give us 29 cents? It has to be a micro lot. So to get or to know the lot size to apply, just multiply whatever value you get after dividing your market risk and capital risk. Whatever value you get, just multiply it by 0.1. This will give you 0.0029. So this is the lot size we would apply, 0.0029. But if you go to the trading platform, we don't have 0.029. So this is how you execute trade in the market. You click on the new order. You don't need an office or to go to a location to trade Forex. Everything is done via the internet. That is why it is referred to as over-the-counter market. Everything is done via the internet, okay, and through the trading platform. So you can see these are the different types of lot sizes. What we have here is micro and standard. And on this list, you can't find 0.029. You can see what we have is just 2 decimal, is in 2 decimal places. There's no 3 decimal here, okay, 3 decimal place, just 2. So we don't have 0.029. So it is either we work with 0.02 or we approximate it to 2 decimal places, which will be 0.03. 0.03 or 0.02. So if we apply 0.02 on this trade, if the trade goes against us, we would lose $14. If we apply 0.02. If we apply 0.03, if the trade goes against us, we would lose $21. Okay, so, and the risk we want to take is $20. So the question now is, should we work with this or this? Should we trade with 0.02 or 0.03? Personally, I would trade with 0.03. Okay, I will trade with 0.03, which means I will be risking one more dollar on my capital, right? On the risk I'm willing to take. So I'm comfortable losing $1 more, okay? So I prefer to take this instead of this. Are you following? So you need to know the lot size, and I just shared with you how to calculate the lot size on a trade. And like I said, we have 3 types of lot size. Micro lots start from 0.01 to 0.09. Now, for those of you who are new to trading, okay, please, after this class, send me a message on WhatsApp so that I can send you the videos of the previous session, okay, where I covered the basics of Forex trading. Please, if you are new to trading, request for that videos so that you have an in-depth understanding of some of the things I'm sharing in this session. Okay, so we have micro, we have mini. Mini starts from 0.1 to 0.9, and standard starts from 1.0 to infinity. Okay, now micro lots 0.01. What does it mean when you execute a trade with 0.01? When you execute a trade with 0.01, what you're demanding for or what you want to purchase is 1,000 units worth of currencies. Let me repeat that. When you execute a trade with 0.01 lot size, what you're demanding for or what you want to purchase is 1,000 units worth of currencies. So if you execute a trade with 0.02, that is 2,000 units. 0.03, 3,000 units. 0.04, 4,000 units, and so on. So someone who is trading with 0.01 lot size, or someone who is trading with 0.05 lot size, will make more profits than someone who is trading with 0.01. The higher the volume or the quantity of currencies you purchase, the more profits you would make. Meaning, when you execute a trade with 0.1 lot size, what you're demanding for is 10,000 units worth of currencies. 10,000 units worth of currencies. If you execute with 0.2, what you're demanding for is 20,000, 0.3, 30,000 units, 0.4, 40,000 units, 0.9, that's 90,000 units. That's for mini lots. For standard, standard starts from 1.0. So when you execute a trade with 1.0, what you're demanding for or what you want to purchase is 100,000 units worth of currencies. If you execute a trade with 2.0 lot size, that is 200,000 units worth of currency. So the lot size you apply on a trade will determine how much profit you would make on that trade, which is in dollars. Okay, so the higher the volume, the higher the profits you will make on that, that trade. Now, the interesting thing about the Forex market is that with as low as $20, or let's say $100, you can purchase 100,000 units worth of currencies, which normally should have cost you $100,000. Let me repeat that. With a capital of $100, you can purchase 100,000 units worth of currencies, which normally would have cost you $100,000. For you to be able to purchase 100,000 units worth of currencies, you are supposed to have $100,000 in your account. But because brokers offer retail traders what we call leverage, without leverage, you won't be able to trade Forex. Without leverage. So broker offers retail traders leverage. Now, what leverage does is that it helps increase your purchasing power. So with small capital, you can purchase high quantity of currencies. This is one of the major factor or the attractive factor. This is what is pulling people to the market. Leverage, because you can start your business with small capital and you can make huge profits with small capital. Imagine someone who is doing a business starting with, let's say, $100, and someone who starts his business with $100,000. Both of them can earn the same amount of profits. Just imagine that. So if someone who starts a business with $100,000 is earning $5,000 on sales of his product, the person who is operating with $100 also can earn $5,000 selling the same quantity of products. So as a retail trader, you must work with leverage. For example, Cabana Capital offers you 1:500 leverage. 1:500 leverage. Some broker offers you 1:1,000. What this means is that with $1, you can control or purchase as high as 500 units worth of currencies, which normally would have cost you $500. So with just $1, you can purchase 500 units worth of currencies. So if you have $100 in your trading account and you apply for a leverage of 1:500, it is assumed that you have 50,000 in your account. 500 times 100, that's 50,000. So you make a deposit of $100 into your account, you apply for leverage of 1:500, it is assumed that you have $50,000 in your account. What that means is that you can purchase as high as 50,000 units worth of currencies, which normally would have cost you $50,000. But because you apply for leverage of 1:500, you'll be able to purchase 50,000 units worth of currencies. That is what made it possible for individuals like me to trade in the Forex market. So without the broker, you can't trade Forex. Okay, so you need leverage. If you can't afford $10,000, okay, the minimum is $1,000. If you can't afford $1,000, if you can't afford $10,000 or $100,000, you cannot trade Forex without leverage. You cannot trade Forex without leverage because the minimum quantity of currencies you can purchase is 1,000 units, which is 0.01 lot size. That is the minimum. So if you deposit, let's say $500, if you deposit $500 in your account, you can't even trade with 0.01 lot size if you don't apply for leverage. If you have $500 in your account and you don't apply for leverage, you cannot purchase 1,000 units of currencies, which is 0.01 lot size. So for you to be able to purchase 1,000 units of currencies, you have to apply for a leverage of 1:2. So your 500 multiplied by 2 is 1,000. So it is assumed that you have $1,000 in your account. And with that $1,000, you'll be able to execute 0.01 lot size. You'll be able to purchase 1,000 units worth of currencies. So you need to know the risk, and I've shared with you how to know the volume or lot size to be applied on a trade. That is clear. So 3 important things. We are still looking at the 3 important things you need to know before you execute a trade. We'll talk about the trend, the direction of the market is the first thing. The second thing you need to know is the risk. And the third thing is the reward. You're taking a risk. And for every risk you take, there should be a reward. There has to be a reward. As they say, no risk, no gain. So if there is a risk, there should be a gain. There should be a profit. So after you've defined the risk to be 70 pips and converting to dollars, that will be $21. Personally, what I do is multiply my risk by 2. So this is what I advise that you should do. Your risk reward should be between, or the minimum risk reward you should apply on any trade should be 1:1.5. That is the minimum ratio 1.5, 1:1.5. What this means is that if you are risking $1 on a trade, your reward should not be less than 1.5. Personally, I use 1 to 2. If I'm risking $1, my target is 2 times, or my profit or reward is 2 times my risk. I never go below that. And if you want to be a consistently profitable trader, your risk reward should not go below 1:1.5. And I'll tell you why. I did said for every trade you execute in the market, there is a 50% possibility that the market would go against you, and there's a 50% possibility that the market will go in your direction. So if winning to loss is 50-50, let's assume you execute a trade, let's say 20 trades. Let's say you execute 20 trades. On these 20 trades, it means there is the probability of losing 10 and winning 10 trades. Okay, worst case scenario, there's a probability that you would lose 10 and win 10 trades. So if you apply 1:1.5 on these 20 trades, if you lose 10 trades, how much would that be? 10 trades, we are risking $1 on every trade. So 10 trades would have a loss of $10. Then 10 winner, or 10 wins. So for every trade, we risk $1 and our profit is 1.5. 1.5 times 10, I think that's $15. So at the end of the day, when we subtract the losses from the profit, we will still have a profit of $5. Can you see that? So if you lose 10 trades and you win 10 trades, you will still be in profit. But if you have a good system, you could win 7 out of 10 trades. You could win 6 out of 10 trades. Out of 10 trades. Are you following? But I'm just saying the worst case, your strategy is not that excellent or good. You are able to win 50% of your trades. You will still be profitable. Now, this is what most traders do, and this is why they will keep losing. Some traders make use of 1:1 risk reward. So they are risking $1 to make $1. If you trade like this, you just keep struggling in the market. You are just playing, for me, you are just playing in the market. Long term, you will not be profitable. And the reason you're trading Forex is to make profits consistently and to make money. That's the reason you are trading Forex. So you cannot be trading with 1-to-1 and be profitable long term, unless you are able to win, your strategy is able to win 8 trades or 9 trades out of 10 trades. That is when you'll be able to make profits consistently, trading with 1:1. Out of 10 trades, you should win 8 for you to be profitable. Okay, you should win 8. So in this case, if you're risking $1 to make $1, 10 losses, -10, 10 wins, $10. At the end of the day, break even. You are neither profitable, right? You are not profitable. You are neither profitable, you're neither losing. Okay, so that is why it is not good to trade with 1:1. 1:1 is still even okay. It's still okay, but most traders, they risk $1 and they're aiming for 50 cents. Some even risk $1 and they're aiming for 20 cents. Some risk $1 and they're aiming for 10 cents. How would you be profitable with such risk reward? You are just playing in the market. You can never be profitable. 1:1 is still okay. Okay, at least at the end of the day, you break even. But anything less than won't be profitable long term. Anything less than 1:1 won't be profitable long term. It won't be profitable. So your risk reward should never go below 1:1.5. So what I do is, like I said, I just multiply my risk. So if my risk on the trade is 70 pips, I'll multiply it by 2. So my take profit would be 140 pips. My take profit will be what? 140 pips. So to get my TP or reward, I just multiply market risk by 2 minimum. I could go for 3 times my risk. I could go for 4 times my risk, but I don't go below 2 times my risk. I don't go below that. So this will be 70 times 2. So this will be 140. So if the risk is $21, 140 pips will be what? $42. I hope that is clear. If the risk is $21, my TP or my profits in dollars should be $42. This is what you need to be a profitable trader. If there's anyone who is struggling to make profit in the market, who has been trading Forex for years and is not profitable, this could be the person's problem. This could be the person's problem. His risk reward is very poor. He's always losing more than he makes in the market. So he's just playing in the market. He's not ready for business. And this is how you know a good strategy from a bad strategy. If anyone is teaching you a strategy that would only give you a risk reward of 1-to-1, you should know that that strategy is not a good one. That's one way to know that a strategy is not good. Okay? If anyone would teach you Forex and would suggest that you risk $1 for $1, then the person is not giving you good advice. It's not giving you good advice. Okay, so those are the 3 important things you need to know. 3 important things you need to know: the trend, the risk, and the reward. I think I've covered all these topics about the Forex market. What is Forex trading? I think I've covered everything. Okay, where to trade Forex. If you joined the class late or you didn't join the previous session we had, please request for the video. Send me a message on WhatsApp. And for you to access the video, you must have opened an account with Cabana Capitals. If you don't have an account with Cabana Capitals, you don't have to send me a message or request for the replays. This session also, the replay is available to those who have an account with Cabana Capitals. Like I said, you don't have to fund. Open an account. If it's a demo account you want to open, go ahead and open the account. Okay. So we've covered a lot. I think that will be all for this session. Okay. That will be all for this session. In tomorrow's session, tomorrow is Friday. Tomorrow is Friday. For most of you, you don't know how to use this trading platform. You don't know how to use this trading platform. And in this session, I have not shared any strategy with you guys. I have not shared any strategy. Okay. So tomorrow, I would share a strategy with you. Okay. I would share a strategy with you that you can use in making profits consistently in the market. I believe that is the reason most of you are in this class, to learn the strategy that you can use to pull out money from this market. Okay, so tomorrow we'll be looking at what is candlestick, the different time frames you can use for analysis, the different types of charts that you can use for technical analysis, how to place your order. We'll be looking at that tomorrow. Okay, so I think we've covered all that. Market watch window, bid and ask price, how to interpret what you have on this window. We'll look at that in tomorrow's session. So if you're in this class, don't miss tomorrow's session. And like I said, most of these things I covered in the previous class. I covered all these things in the previous class. So please request for the video so that tomorrow when you attend the class, you'll be familiar with the terms. It will be easy for you to understand some of the terminologies I'll be using in tomorrow's class. So ensure that you get the video. Ensure that you get the video to make it easy for you tomorrow. Get the video. Okay. So now I would like to take your questions. Let me start with Mr. Thompson. Mr. Thompson, you can unmute your mic. If there's anything you don't understand, please ask. Anything you don't understand, please ask. In as much it's about Forex, I will attend to your question. Mr. Thompson, you can unmute yourself. Mr. Thompson, if you can hear me, unmute yourself.
Okay, good evening, sir.
Evening, sir.
Yes. I want to first of all recommend you for the opportunity given to us, at least to have
Thank
access
you,
to this class.
Thank you.
So may God bless you for that.
Amen.
My question is, it will really comment tomorrow, at least when you open the interface, so that
Okay.
there are some things I would like to know from there.
Okay.
Thank you very much.
So please request for the video.
Okay, I will.
I believe you've opened an account, right?
No, I have not,
but I will do. You registered for this webinar, right? With the link that was provided.
Yes, I joined with the link.
With the link that was provided, you registered,
yes,
right?
I didn't register.
Okay. Okay. So please, after the class, send me a message on WhatsApp so that I'll forward the link to you.
Okay. Thank you.
All right. So that I can get the video, so that you watch the video before the session we'll be having tomorrow. Okay.
All right, sir. Thank you so much.
You're welcome. Mr. Akpako. Mr. Akpako, you can unmute your mic.
Yes. Hello, sir. Can you hear me? Good evening.
Loud and clear. Good evening.
Yeah, although I came late, sharp, so I will request for the video.
Okay. Are you an experienced trader?
A little bit.
Okay, good. Okay. So request for this video. video of
Okay.
tonight's session. So
All
if
right.
you have if you have traded before, means you understand the basic concepts, right?
Yeah.
Buying and selling and all that, you know all that. Okay, so request for
Okay.
tonight's session. Okay.
All right. Thank you, sir.
Have you opened account with Cabana Capitals?
Yeah. Sure.
Okay. All right. Thank you. Mr. John. Mr. John, do you have any question?
Good evening.
Evening.
Yes, I for now I don't have any much question. It's
Okay.
just that I think we will need a video for the previous class so that we can be able to.
Okay.
Yes.
Please send me a message on WhatsApp. I believe you have my number.
Yes, I've sent you a message. I've dropped a message for you.
All right. And you've opened account with Cabana, right?
Yes, you called. Yeah, I think somebody called me. I don't know whether you are the one that called.
Okay.
Yes,
So I
Thank
would
you.
attend to your message later. Thank you. If you're the one using Infinix Notes, if you have any question, you can unmute yourself. If you're the one using Infinix Notes 10, you can unmute your mic if you have any question. Any question from Infinix Notes? Mr. Solomon? Okay, I'm about to unmute you. Evening.
Sir.
Good evening.
No, I don't have no.
Are you an experienced trader?
Hello.
Are you an experienced trader?
Okay, I'm really new to the whole system.
You're new, so please request for the replay.
No.
For the previous session and this session. Okay?
No, sir.
Can you hear me?
Oh,
you said you're new. You're a new trader, right?
Yes, I can. Yes,
sir. Do you have my number?
Yes, sir. Yes.
Do you have my number?
No, sir. No, sir. No, sir.
Okay, I'll drop it on the chat space now. I'll drop my number on the chat space. Send me a message on WhatsApp so that I can forward these videos, the video for this session and the previous session to you. Okay. All right. Thank you.
Okay, sir. Yes, sir. Thank you.
Okay, Mr. Solomon. Let me quickly drop my number. Mr. Solomon, you can mute your mic. Mr. Solomon, you can unmute your mic. I've granted the permission. So I just dropped my number. Mr. Solomon, I just granted you permission to unmute your mic. Okay, unmute your mic.
Okay. I've gotten it now.
All right. Please send me a message.
Yeah, thank you very much for the information.
Welcome. You're welcome. Mr. Solomon, I can't hear you. I know you're talking, but I can't hear you. I guess the network is not stable. You're talking, but I can't hear you.
Most of the information, Hello?
Okay, I can hear you now. Let me unmute you. Okay, unmute your mic. Unmute your mic.
Can you hear me?
Hello?
You can hear me, Abi?
Yeah, I can hear you now.
Yes, I said I would love to go through the information again. They are
I sent the previous video to you, right? I gave you access.
Okay.
Right?
Okay.
I sent it to your mail.
Okay. I will check the mail now. I have not opened my mail.
Okay. And for this session, just drop me a message on WhatsApp.
Okay. Then about the registration with Cabana,
Yes, sir.
What and what will I need to do registration?
You register and provide your documents,
Okay.
ID card, and
Okay.
utility bill. Now, ID card could be
Driver's
driver's
license.
license, national ID, voter's card.
Okay.
I'll suggest you use
All right.
one of those 3 ID cards: national ID, voter's card, or driver's license, because you can use those IDs as your utility bill or as your proof of address document, because you have address on those documents.
Okay.
So you can use that. So you upload your ID. If you're using national ID, upload it as ID. Also upload it as your proof of address document. Okay. Then you take a selfie with your ID. Take a selfie with your ID. So those are the 3 requirements.
Okay.
Upload them so that your accounts get verified.
Okay.
Okay.
Okay. Yeah. What of the address?
My plan after this session is to help those who will fund their trading accounts, not only with education. I also want to help them by providing signals. Okay. So just fund your trading account, and you'll be receiving signals every day. You have access to class where you'll be told what you should expect for the next trading day. Okay. So you're always prepared before the market opens. You have access to daily market analysis session.
Okay.
Okay.
Okay. Okay.
All right. I think that'll be all for tonight's session. I really appreciate you all for your participation. My greatest desire is to see every one of you make money from this market. That is my greatest desire. And I'm willing to give you my best. Okay? Do have a wonderful night. Kenny, unmute your mic. Please, others, you can exit.
Good evening.
Yeah, Kenny, Alpha.
I'm fine, bro. Good
How
evening.
you doing now? How is trading?
Fine, I thank God.
Let me end this.